and welcome to this episode of Policy and Profits. I'm Anthony Esposito of Ascalon 6 Capital, joined by, as always, Mr. EJ Antoni, lead economist, head economist, world beater at the Heritage Foundation. How is everything today, my friend?
Busy. Another busy day of economic data coming out. Busy as always with the news. Every day we get something new on tariffs, and we're finding out more about big beautiful bill and different regulatory changes. I mean, it's drinking from a fire hose. So, but I am hanging in. How are you doing?
I'm doing well. The tariff conversation kind of seemed to quiet down a bit on the trading desk for sure, as we've had this massive, relief, nothing's wrong, climb the wall of worry rally. And then this week we kind of got a little bit of an uptick in conversation. Trump coming out with the 50% tariff on copper, which was very exciting for for those trading Freeport and those names, and trading copper itself hitting an all-time high.
Yeah.
But there's been some real refocus now on tariffs and what the models should say and what's going on with them. So we have a couple of cuts. I really want to get your take on the revenue that we're seeing so far from tariffs. Is it working? And then B, what's going on with prices? Supposed to be super inflationary. Powell's super worried about tariffs and prices. Can't figure out what the data is saying. But there are some real data points as we're starting to see the year unfold. We're seeing some clues as to what is happening on the tariff front and the economic growth front, the inflation front, jobs. Let's focus on tariffs now. This is Scott Besson speaking to President Trump in the cabinet meeting.
We've taken in about $100 billion in tariff income thus far this year, and that's with the tariff. The major tariff not having started till the second quarter, so we could expect that could be well over $300 billion by the end of the year. We don't agree with CBO scoring, but for those who do, the CBO scored tariff income over the next 10 years at $2.8 trillion, which we think is probably low.
Okay, so as far as revenue goes, are these numbers meaningful, and are they legitimate, sustainable?
Yeah, I think both. People who really downplay these numbers and say, "Oh, it's just a one-time bump; it's never going to be repeated," or who say it's not significant. I'm sorry, that's not what the numbers indicate. Now, at the same time, let's be fair here. The idea that somehow this is going to be a game changer in terms of the overall budget, okay, the numbers aren't there for that either. Right, we're talking about a government budget that is several $1 trillion. So to have tariff income that goes from 10 or 20 billion to 120 or even 320 billion, that's not a game changer, right? It has a positive impact, absolutely. It's a good thing. It's going to help reduce the deficit, et cetera. It's a nice way for us to also shift some of our tax burden overseas, but it's not as if it's going to completely eliminate the deficit, right? So I think both sides of the political spectrum here can kind of take this talking point and run the wrong direction with it. But if we're going to be fair here, if we're going to play it down the middle, yes, it's important. Yes, it's significant. Yes, it's sustainable. No, it's not going to, change the world, so to speak.
No, I agree with that. But I kind of look at it, in I'll put it in football terms because I'm a football guy. It's you're first and 10, and you run a dive on first down and you get 3 yards. Now you're second and 7, so that's better being second and 15. So we're moving in the right direction. If we can save 100 billion or 200 billion or pull that money in, we're kind of moving in the right direction. And then, I talk about this because you've mentioned it and I've kind of dug in on it a bit. It makes a lot of sense. Every dollar that we can pull back from slushing around the globe is actually beneficial on an inflationary front, and also beneficial where we're almost pulling back wealth into the United States, right? Those dollars that get sent out, and I really do believe in this, those dollars that get sent out come back as foreign investment, right? So US dollars coming back. So we have these massive trade deficits. We're sending dollars across the globe. Those dollars come back into the country. And guess what? They buy US assets. whether those are soft assets or hard assets, they're buying U.S. assets that otherwise would be owned and would be profitable for U.S. citizens versus foreign nations, foreign nationals. So I think on those two fronts, it's definitely, would you agree, moving the ball forward to some degree?
Yeah, absolutely, Anthony. Right on all points. Love the analogy, and to emphasize what you were saying on investment. This is where Nvidia, for example, gets all of its capital to make the productivity increases that they do, to make the technological advancements that they do. They're living not primarily on domestic investment, but on foreign investment. That's a good thing. We talk about the trade deficit as if it's always and everywhere bad. Not necessarily. Sometimes it is, sure, but not necessarily. From even before our nation was founded, if you want to go back all the way to colonial times, through 1870, so that's a pretty sizable period, right? Over 100 years there, we had a trade deficit every year except for 7. 4 of those were because we were at war with the British, either during the Revolution or the War of 1812. And then the other 3 were banking panics when Americans were basically so broke we couldn't afford imports. So for the rest of the time, we had a trade deficit and an investment surplus. Money from around the world poured into the United States and gave us the best periods of economic growth that we've ever seen. So again, this idea that somehow the trade deficit is horrible and we need to get rid of it. No, it's not always and everywhere bad. It's like, are you putting on weight because you're gaining muscle, getting ready for football season? Or are you putting on weight because it's the off season and you're sitting on the couch eating carbs and you're just getting fat like me?
Well, I have one 20-year-old who could relate to try and put on some muscle for the football season. He's trying to gain 30 pounds in the next 4 weeks. So we'll see how that goes. So the next clip we have, well done, and I agree with you. And that trade deficit conversation, trade deficit view you have it's extremely important. And it's a big part of this tariff conversation, which I think most people keep saying tariff and tax, but trade deficit should also be considered. That's really a big part of this consideration. And we go into that after the next clip. We're going to go into that. You had posted something really great about that this week. This is also the U.S. Treasury making statement. Is it Livornia? I think we have Livornia up. Is that who we have?
What's amazing is in Stephen's piece, they did such great work, is that if you look at the goods piece, it actually fell. It's 50 basis points lower than what overall PCE goods have shown. So imports of goods were down. And in the CPI, the Consumer Price Index, well, that's not the Fed's preferred measure. That's the measure that most businesses and households know about. That fell even more. So it's not even like inflation is under 2%. It actually fell for those goods that supposedly were supposed to go up because of the tariffs. It's really remarkable. And it reflects the fact, as you and I have talked before, foreign producers have absorbed this in their margin. The U.S. being the biggest consumer in the world really dictates the terms, and President Trump knows that.
So these net export nations, as you suggested back, and you've been saying this for months. I mean, we were down in Houston back in February, and I was listening to you speak about tariffs and how those prices, what will happen to prices, and what historically has happened, whether it be academic or in reality. We're not seeing prices go up. So why don't prices go up? We've heard things about the FX rates, the currency rates changing, and that helping. We've heard about export nations needing to eat the tariffs or to take on those expenses in order to continue to do business with the U.S. because we are their largest client and we are the largest consumer. We've heard things like onshoring of production, whether it be those foreign companies investing in the United States, building in the United States because of tariffs, but doing it here to avoid tariffs, which obviously is, I would say, a great option. All these things are kind of wrapping up as you expected. Do you see that developing the way you thought, and do you think that continues?
I do. I think we're gonna continue to see things move along the same lines. The basic principles here really haven't changed. The basic dynamics really haven't changed, and part of that is the fact that we haven't actually had to go toe to toe yet with anybody, right? We haven't, Anthony, when you think about it, really had to get into a knockdown, drag out trade war with any of our major partners. Every time they've always backed down, whether that was China saying, okay, let's talk about this, let's not do this. Whether it was Canada saying, oh, okay, we'll drop the digital services tax, just please, let's not do this. Or Vietnam saying, okay, we'll take the deal. We don't even want to go any further down this route. Yeah. Literally every time. Now we're hearing that the EU, the leader in Germany is saying the EU is ready to make a deal too, Mr. President. I think we're going to continue to see this dynamic. We're going to continue to see progress towards more deals and hopefully a fairer shake for American exporters and American workers at the end of the day.
Awesome. I like it. I think things have really have played out. And I say this for real, but kind of tongue in cheek, that they've played out how, President Trump has said they would, like most other things. I mean, it's what's that new hat, Trump was right about everything. I mean, it always seems like he'll say the most outlandish thing and everyone will get in a total uproar. He'll be fishing everybody. And then at the end of the day, it's like, maybe it's a month later, maybe it's a year later. You turn around and you go, oh, actually, he's kind of right about that. I was talking about Carney yesterday in Canada, and, my statement was he's in a sword fight and he's using a toothpick. The whole DST tax, he comes at America as if he grandstands. First of all, he uses the tariffs to create or to step into a snap election in order to steal, quote unquote, steal the election or push the election along quickly so he can take office. And now he grandstands up and down about how they're going to fight the U.S. They're not the little brother to the U.S. They are Canada, and hear us roar. And at the end of the day, you're not helping yourself or the Canadians. You're kind of shooting a dinosaur with a pea shooter. And President Trump's kind of giving him a pat on the head, like, yeah, okay, that's great. You want to threaten me with taxes on our tech companies? We'll just tax copper at 50%. And since 50% of the copper you export comes to the U.S., good luck. Have fun. And then he kind of quivers back, which all I want is fair trade. But the personalities and the negotiations, to your point, there's a lot of noise, there's a lot of ruffle, and then everyone seems to get in line because at the end of the day, President Trump is right. We are the largest consumer in the world. We're the largest economy in the world. And the trade deals as they stand really are not fair. The trade deals as they stand benefit foreign nations and do not benefit the United States. So let's just kind of get these in line. It's hard to fight that at this point. Get them in line to what's more fair. You had a great chart out on X. I want to go to this, and it had to do with trade deficits, and it had to do with services versus goods. Please dig into this because I did not realize this spread or this analysis kind of took me by surprise a bit.
Yeah, we talk about the trade deficit all the time, right? The balance of payments deficit. And we forget that it's really just driven by products, not by services. We are a massive, massive exporter of services to the rest of the world. A lot of that's financial, a lot of it's tech. But whatever the case is, you can see here, we exported almost $1.2 trillion of services last year. How much did we import? 800 something billion. So there's a pretty substantial surplus there, several $100 billion. And because we get so laser focused on the trade deficit just in terms of products, which is important. I'm not saying it's irrelevant. I'm not saying there are no side effects there, especially with manufacturing and our industrial base, et cetera. But I think we lose sight of the trade in services. And one of the reasons why that's so harmful, Anthony, is some of the things you were just talking about in these trade negotiations. It's really important that we make sure American businesses who are employing Americans, more so for services, because you can have the services conducted here and easily export that around the world, versus the products. Very oftentimes, American companies, it's easier for them to make products like in Germany if they want to actually sell the product in Germany. Yeah. For services, though, in our digital age, we're talking to each other on webcams and whatnot. You can do services from anywhere. So it's even more important in the service sector that you get these free trade agreements in place. And so looking at something like the EU, a big reason why the president is so laser focused on some of their things like value-added taxes and other measures that basically function as an explicit tax on American service companies, he sees that as a tariff. And
Mhm.
he wants that gone because it acts directly like a penalty on our service industry. So what I'm trying to say here is it's not just about exporting more products. It's about exporting more services too. And you could see a real economic boom in this country, not just in manufacturing, but in things like tech and in things like financials, if we were actually allowed to do business in those different places. And looking at a country like Canada, I know the president has caught some flack for really hammering the Canadians. And people say, oh, they're just our friendly neighbor to the north or whatever, But at the end of the day, it's not just that they impose very unfair trade penalties on things like American dairy. It's not just that they allowed the Chinese to abuse country of origin laws and then dump product into the United States using Canada as an intermediary. It's also the way in which they essentially penalize American financial firms and make it almost impossible for those financial companies to do business in Canada. That's a real issue too. It's not just about exporting more cars around the world. That's important, but it's not just about that. It's more than that. It's about, again, allowing chiefly our tech and our financial firms to export their services too. It's something a lot of people just never talk about. And I'm sorry if I'm really hammering this, but I just think it's so important.
It is, because we talk about the tariff, the quote unquote tariff conversation, but there are a lot of non-tariff barriers like this VAT, which people need to understand exist. And it's specifically and well said that VAT tax is actually eating away at the advantage we do have as far as the surplus and services out. So it's important stuff. As someone that's worked for well over 30-year career, two Canadian banks at different times, I can tell you, one, don't do it ever, and two, and two, there is definitely a very hard line, Canada to U.S., even within the bank. It's a very different feel, and I would challenge you to go up to Toronto and find a JP Morgan Chase ATM anywhere in sight. Whereas in the U.S., obviously the opposite. You're at a TD ATM, a Santander ATM. Across the board, it's much more of a melting pot of global firms versus what Canada runs and how Canada runs, specifically in the financial and tech industries. I want to go over to Donald Trump. It wouldn't be an episode if we didn't talk about Mr. Powell. Donald Trump out again, talking about the CEA study. Basically saying that the excuse that Powell has been using for inflation is a non-excuse. There's been zero impact. Study shows that import prices actually dropping, which we're talking about, just like always. Just like I always said they would. Fake news and so-called experts were wrong. Trump was right about everything. Tariffs are making the country boom, boom. Many new factors, jobs, and trillions of dollars of investment pouring in. Jerome Powell, you're wrong. Now's the time. Cut rates. So I want to go back to rates for 1 second, because it's definitely becoming something the markets are focused on and thinking about again. It's the shiny ball once again. Where should he be cutting rates now, and why?
I think he should, but he should be doing it indirectly. What I mean by that, Anthony, is he needs to just allow the market to set its own rate. It's like letting water seek its own level. It's pretty clear, in my opinion, that the market rate would be lower if we were actually to allow the market to set the rate. But the problem is the Fed is so in control, probably more so today than ever before, because of additional steps they've taken just within the last 5 years or so. For example, the Fed never used to just pay interest on reserves. At one point, they were paying interest on excess reserves. So that was there to encourage banks to keep more than the reserve ratio, the requirement. But today, they don't even have a reserve requirement. So that means they have to keep rates above the market rate in order to get banks in order to convince them to take that risk-free rate of return. So that things like that immediately tell you can look at reverse repos as well, but there are lots of different things that the Fed is doing, these different policies they're conducting that tell you interest rates must be above market rates, because otherwise banks would not have an incentive to keep their money parked at the Fed. So the reason I want to make that nuanced point, though, is because it's not as if the Fed should simply drop the Fed funds rate and that's going to solve all of our problems.
Yeah, exactly.
Clearly, if they do that, they're going to have to change open market operations and a few other things. A lot of that's going to be inflationary, though. And the problem is that if you artificially try to manipulate rates down, like you did in the fall, you're going to see exactly the same outcome, which was the Fed funds rate drops 100 basis points and Treasury yields don't go down, they go up 100 basis points, as you know. So can you imagine what inflation expectations and what investors' yield requirement would be if the Fed were to do something like cut 300 basis points today? Everyone is immediately going to demand a huge premium in the Treasury market as protection against the inflation that they'd be anticipating. So that's very, very different from, again, what the Fed should do, which is wash their hands of it, go back to normal operations, have a reserve requirement, and that's it. No more paying banks interest to just keep money parked on the sidelines. Let that money go into the Treasury market, and have a new Fed chair who actually works really hand in glove with the Treasury Secretary to ensure smooth operations in this massive, really unprecedentedly so, massive restructuring of American debt. Never before have we had to refinance this much debt before. Yeah. And so, again, it's just imperative that you have somebody who is willing to let rates be what they will be, but at the same time ensure that they're as low as possible by conducting smooth operations, working with the Treasury.
Yeah, I'm always a fan of let markets be markets, kind of take their finger off the scale. This idea of the Fed not being independent because Trump is criticizing them is absurd. The president is allowed to express his opinion and still have an independent Fed. It's not one or the other. I heard somebody today on CNBC actually talking about the fact that President Trump was criticizing Powell and is expected to really come after Powell in the coming 3 to 6 months. You're seeing the dot plot and the expectations change because of President Trump's criticism. And I'm saying to myself, well, did you consider that there's just a change in expectations for economic growth or inflation numbers, or where those numbers are coming from, where the market analysts are seeing a possible shift in rates? So, I mean, everyone's really enamored with this independent Fed and the Powell or the Trump criticism of Powell. But at the end of the day, to your point, if the Fed was to just kind of back out of the game, wash their hands of this, and allow the system to be obviously regulated, but allow the system to function and not be over incentivized to change liquidity, for example, with the bank rates, with the reserve requirements, that would actually help a tremendous amount, and help in a real way where yields would start to come down. And we would see that direct effect in the market where, and we've talked about this before, where if we can see yields come down, opposite of what he did in September, where he cut rates because of the election, politicized, and then we had the 10-year yield rally 150 or 100 basis points, see rates come down, which would help not only mortgage rates, would help car loans, would help credit card rates, would help loan rates, personal loan rates. It actually would put us in a much stronger position and help what is at this point a struggling consumer in the U.S. You can cut it up however you want to cut it up. The consumer is struggling in the U.S. That's where the real benefit would be. And on top of which, there's a massive amount of debt. And again, I'm taking your talking point, so I'll be quiet in a minute, but what is it? A third of our debt needs to be rolled in the next 12 to 16 months because it's all shorter term debt. So how do we roll that at higher rates when we're spending $1 trillion a year already servicing this debt?
So it's a great point, and this is why I really hope.
I'm glad you like it.
No, but truly, Anthony, this is why I am hoping and praying that Scott Bessent does not get tapped to be the Fed chair. It's not that I don't think he'll be able to do a good job. It's just that I think nobody else could be as good of a Treasury Secretary as him. And we're going to need him. He's a master of sovereign debt markets. We're going to need him to refinance the debt when rates do come down. And so you can't pull him, in my opinion, and have him go to the Fed to lower rates, because at the same time you'll need him at the Treasury to be refinancing the debt, to be rolling it over. So again, this is where I say you need a Fed chair who is going to work hand in glove with Mr. Bessent in order to make this happen and to make this transition as smooth as possible. Because, I mean, this is something we were talking about probably a year ago with Janet Yellen, how she was manipulating the yield curve and taking all of these notes and bonds and shoving them into bills, essentially. So from medium and long term into short term debt. And that was countering some of the Fed's QE activity, but it was also making it extraordinarily expensive in the short term for the government to finance the debt. That continues today. And now, unfortunately, we're in a position where yields across the board, really, across the maturity, whether it's short or long term, have more or less been trending towards 5%, which is not good. Yeah. And it basically means that as the debt approaches 3.8 or 38 trillion, you're going to be spending 1.9 trillion in interest a year just to service the debt. It's not sustainable. That really will break the back of the federal budget, of the taxpayer, et cetera. So you got to get yields down. And you have to wait, unfortunately, until the yields come down before you can take all of those treasury bills and start returning them to notes or even bonds, locking those yields in at, for let's say 10-year for the notes or 20 or 30 years for the bonds. But again, Yellen really, it's hard to overstate this. She really left a complete and total mess. I know you love man hands Yellen, but she really just left a total mess at the Treasury with this impossible situation of we are stuck overpaying essentially to service the debt until we can get yields down and until we can lock in those lower yields.
Look, Yellen has been a problem forever. And I'm not attacking her personally. I just, in my view, when you have somebody who's at the Fed and at the Treasury, who is a fan of MMT, of modern monetary theory, saying that we could create and distribute as much debt as we'd like, and we can maintain normal levels of inflation simply by taxing the citizens. The idea is insane to me. And I'm not particularly an economist. I'm not an economist at all. I don't even play one on TV. I'm the profit side of this thing. But the idea is insane. As a taxpayer, as a trader, as somebody who's, in the meaty part of the intelligence curve and somebody with some gray matter between my ears, it just doesn't make sense. And she tested it. She failed. And then what was particularly insulting, more insulting than the 16 trillion in debt that she oversaw as the development of, or the creation of, what was more insulting is as she left, she waved goodbye and said, "I think you guys have a debt problem." Like headed out, exit right. Stage left. I mean, it literally was like a supervillain, like scooting out the back door of the bank with the money over their shoulder, saying, "I think you guys are going to have a problem," and then scooting out. So, Yellen, I'm not a big fan of. Powell, I'm not a big fan of. I would love, and I say this about Biden too, I would love to be a big fan of everyone who is in a position to help this country and help the citizens of the country. I really would. Like, I don't care if there's a D or an R in front of your name. I don't care if you are liberal or conservative. I just don't care. If you're in office, if you're the head of the Fed, the chair of the Fed, or the secretary of the Treasury, I need you to do a good job. And I need you to be genuine, upfront, transparent, and do what you think is best for the country, not what you think is the greater moral high ground or greater moral path of experimenting with everyone's life and the globe in general. Like, I'm not okay with this experiment. I'm not okay with how disingenuous these people have been. So nothing personal against Ms. Yellen. I hope she lives a very nice life and continues on completely out of sight, out of mind. But they've been a debacle. They've been a debacle. It's a massive mess, and we're just trying to clean it up. To close it up, I think Secretary Bessent has been as expected because of his background and because of what he's done, where he's been, and just kind of stepping onto the scene. It's funny. I was asked like probably a year ago now or 8 months ago, whatever, which of the candidates I thought would be best for the Secretary of the Treasury. Um, and I said best and simply because I'm a Wall Street guy, and I've been on the sell side, I've been on the buy side, and
Mm-hmm.
I just felt like his poise and his expertise and his experience would be of value. And let me tell you something, he has been, I mean, he's been, in my view, he's been aces, man. He could travel the globe, make deals, speak in front of crowds anywhere in the world, and be engaging, be intelligent, understand what he's saying, and capture the people he's speaking to. It's a very, very welcome uh, breath of fresh air compared to what we had with Yellen.
Yeah, amen. I mean, whether it's him conducting himself like that clip we saw in cabinet meetings, conducting himself in public speeches or in congressional testimony, media interviews, I mean, you name it, his equipoise is really something remarkable. His breadth of knowledge of financial markets. I mean, I can go on and on, but he really was definitely the right pick for the job. And people may criticize him and say, interest on the debt is still going up or whatever the case may be. Like I get it. In certain ways, you can clearly make the case our financial situation is getting worse, not better. Remember the absolute mess that was dumped in his lap. I mean, truly an absolute catastrophe. So you're basically asking him to make, chicken salad out of chicken, what, and he is somehow managing to do it.
He's getting there. He's getting there. EJ, thank you, my friend. Great episode, great conversation. I really, really enjoyed the analysis and the breakout on services versus goods in this trade deficit and tariff conversation. I think is real important. Something I'm not seeing everywhere. When I saw it posted, I was like, that's got to be in the show this week. So I'm glad that you put that out. Keep putting out everything you do. You do a phenomenal job, and I definitely I'm on your feed often just to see what you're thinking, what you're doing. Thank you for the time.
Hey, I'm on yours every morning checking out the market note.
There we go. Until next time, my friend. Have a good week. I will talk to you soon.
Same to you, Anthony.
Thank you.